Hi everyone, my name is Douglas Kereo. Welcome to my YouTube channel, D Kereo Education, the #1 education channel. In this channel, we'll be covering all economics, IGCSE, AS and A2 content, including solving past examination questions. Please feel free to watch, like, comment, and don't forget to subscribe. If you have any questions, do not hesitate to ask on the comment section below. Hi everyone, in today's episode, we will learn about AS and A-level economics formulae. We want to start with a number of formulas that we have in economics, which are really helpful in making us understand economics. Let's start with the first one. Let's look at aggregate demand. Aggregate demand, abbreviated as AD. Aggregate demand is the total demand for goods and services in the whole economy. Now, AD is equal to consumption plus investment plus government spending plus net exports. When consumption increases, aggregate demand also increases. When investment increases, aggregate demand also increases. An increase in government spending increases aggregate demand. An increase in exports increases aggregate demand, while a decrease in imports leads to an increase in aggregate demand, and vice versa. Let's move on to the second formula. Let's talk about average rate of tax. The average rate of tax is the amount of tax income that goes to the government. So, tax that the government takes from a given amount of income. For instance, if someone earns, let's say, $1,000, and then the government takes $200 in tax, then the average rate of tax will be equal to 200 divided by 1,000, which is 0.2. That is the average rate of tax. Number 3, let's talk about marginal rate of tax. The marginal rate of tax is the change in tax divided by the change in income. The proportion of extra income that is taxed by the government. So in this case, if an individual's income increases by, let's say, 2,000, then the government from this may take an extra 200 shillings. So in that case, the marginal rate of tax will be equal to 200 divided by 2,000, which is 1/10, which is 0.1. So from extra income that an individual earns, the government takes an extra amount in form of tax. That is marginal rate of taxation. Now let's move on and talk about cross elasticity of demand. Cross elasticity of demand is the responsiveness of demand for, say, good A due to a change in the price of good B. Therefore, XED is equal to the percentage change in quantity demanded of good A over the percentage change in the price of good B. Now, these two goods could be complements or substitutes. If the two goods are substitutes, the XED will be a positive sign. Meaning, when the price of good B increases, the quantity demanded of good A will also increase. Take an example of tea and coffee. If the price of, for instance, tea increases, people will consume more coffee because tea has become expensive. If the relationship between the two goods is negative, then that means complements. So XCD is equal to negative, meaning the two commodities are complements. That means they are used together. They are jointly demanded. So in this case, when the price of good A, for instance, increases, the quantity demanded of good B decreases. Negative relationship. Take, for example, two commodities which are used together, like car and petrol. So let's assume the price of petrol increases. The quantity demanded of cars will reduce, simply because petrol has now become expensive. Now, XCD can be greater than 1 or less than 1. Let's move on to the fifth formulae. I want to look at PED. PED is the responsiveness of demand to a change in price. Therefore, PED is equal to the percentage change in quantity demanded over the percentage change in price. Now in this case, our PED value will always be negative. The negative is an indicator of the relationship that exists between price and quantity demanded. So for instance, let's assume the price of a shirt in a sale rose from $10 to, let's say, $15. Now in that case, it will lead to a decrease in quantity demanded from, let's say, 1,000 units to, let's say, 800 units. So if you do quick math, the PED of this commodity will be equal to the final output, take away initial output, divided by initial output times 100, divided by the final change in price, take away initial price over initial times 100. The percentage change in quantity demanded will be equal to Q2, which is, guys, we have to identify which one is Q1, Q2, P1, P2. So the initial price is here P1, the final price is here P2. Initial output Q1, final output Q2. So it's equal to 800 take away 1,000 divided by initial, which was 1,000, times 100 over P2 is 15, take away 10 divided by 10 times 100. So in this case, this is negative 200 divided by 1,000 times 1,000 over 5 divided by 10 times 100. So 1, 2, 1, 2, and this cancels. So this is negative 20 divided by 50. So this and this cancels. That gives us negative 0.4. Therefore, the PED for this commodity is negative 0.4. Now, PED can be greater than 1, meaning elastic. PED value can be less than 1, meaning inelastic. The PED value can be equal to 1, meaning unitary. PED can be equal to 0, meaning perfectly inelastic, and PED can be undefined, meaning perfectly elastic. Now, whenever you want to interpret the PED value, you look at the absolute value. So in this case, we will ignore the negative. So when we ignore the negative, that gives us 0.4 in absolute terms. So if it is 0.4, then that means it's less than 1, hence inelastic. If the PED, for instance, let's say is negative 1.2, and this means in absolute terms, ignoring the negative is greater than 1, therefore price elastic. If PED is negative 1, in absolute terms, that means it's equal to 1, therefore unitary. If PED is, let's say, 0, and that means it's perfectly inelastic. If PED, for instance, if the percentage change in demand is, let's say, 10%, while the percentage change in price is 0%, then that means this cannot be divided. You cannot divide something by a 0. Therefore, it will give you this undefined. Therefore, it's undefined, then it's perfectly elastic.